I would say you could, I'll boil this down and summarize, which is the law of the land and regulations is detrimental to operating companies. Operating companies are not allowed to have an endowment or a balance sheet. They are discouraged from having positive capital. They're encouraged to run the business on negative capital, liabilities, not assets. Endowments, nonprofits, religious organizations, churches, and institutions are able to run on positive capital. So those entities are beneficiaries of monetary inflation to the extent that they invest in scarce desirable assets. And then operating companies are just like workers, laborers, right? They are discriminated against. They are the victims of monetary inflation. High monetary inflation is a road to serfdom for the worker, and it's a road to serfdom for the operating company. And the reason that we have capital markets that are tending toward monopolies, and the big just keep getting bigger, right? Big tech, big pharma, big banking, big utilities, big government, big entertainment. The reason they keep getting bigger is the monetary policy destroys anybody's ability to accumulate capital or lever the capital. And everyone is encouraged to engage in irrational, short-sighted behavior, right? You've got a nice company. Here's my advice for you. Give away all your profit. Go buy companies that aren't as good as yours as fast as you can and overpay for them. And borrow as much money as you can at whatever interest rate you have to pay. And then keep buying back the stock of the company with the cash flow so that you have no cash. You have only liabilities, and you're in a hurry and you have to buy another bad company and then buy a company twice as big as that's even worse, and keep buying bad companies that are in trouble at too high a price until eventually you blow up, right? That's conventional treasury strategy. And you might say, well, if that's true, if it's that irrational, then shouldn't I expect to see the majority of companies failing and going out of business? And I'm like, yeah, it is. Well, look at them. They are. If you actually study 100,000 companies created in the past 30 years and ask how many are still here and how did they fail, you'll find they all sold out. Many of them did a succession of acquisitions and then failed, or they all sold out, or they were rendered insolvent, or they couldn't pay back their debt, and eventually they threw in the towel. And then who wins? The digital monopolies win, right? John D. Rockefeller rolled up all the other oil companies, and the big tech companies will just roll up every other smaller company. And in the meantime, investors will do these LBOs to try to squeeze something out of the companies in the interim.
We got into this conversation quite honestly thinking that we were going to compare Bitcoin to treasury securities and maybe the risks of each and the investment properties. But instead, the direction that you're going here, it's much more societal in nature. What you're actually saying is that the endemic and systemic inflation completely distorts the operating company's motives from being an entity that can create an endowment and accumulate capital over a long time to an entity that is forced to get rid of the cash as fast as it can and engaging in mergers and acquisitions in which actually just creates these large monopolies. And so we're talking about something much more societal in nature than just comparing the risks of two different asset classes. So talk a little bit more about just societally what you see. Is it this new fair value accounting rule that is going to unleash some maybe behavioral changes in the society, or is it already underway because we have Bitcoin? Talk to us about that.
Well, we use the phrase Bitcoin fixes this, right? Bitcoin is sound money, and Bitcoin is thermodynamically sound financial asset and a thermodynamically sound strategy. So people haven't had a thermodynamically sound saving strategy up until now, right? The closest thing to sound money in the current world before Bitcoin is scarce desirable real estate. That's the closest thing. And most wealthy families, most wealthy investors I run into, they own real estate, and they own real estate in London and Paris and New York and LA and middle of Miami, places that people want to be. And the strategy for accumulating wealth is levered long property. right? If you really want to get rich, then you have to borrow a lot of money, buy something highly desirable, hold it for a long period of time, wait for the monetary inflation to drive up the value of it, right? You bought $1 billion worth of real estate in London, you paid 3% interest, it traded up 7 or 8% a year, and you're generating 4% yield on $1 billion every year for 10 years, and all of a sudden you've just made yourself hundreds and hundreds of millions of dollars, right? So that has been the only strategy. I think Bitcoin is now emerging as something superior to that. Bitcoin allows you to take on a strategy of acquiring scarce desirable property, but now you can acquire it in units of $20 at a time or $200 at a time. And so it's an egalitarian strategy for wealth creation or wealth preservation. The big catalyst here, I mean, the first one was, Satoshi's creation of Bitcoin, right? Put a big star on the map nearly 15 years ago, coming up in a few weeks, is the anniversary of the white paper. The second big milestone was the end of the block size wars, when Bitcoin was established, as this censorship-resistant network that's resistant to the meddling of corporate interests and others, and we sorted out what's the dominant chain, and a lot of theory and a lot of values got cemented in the block size wars. I think the third milestone is the entrance of is actually COVID and the entrance of corporations, right? COVID catalyzed corporations to look at Bitcoin. So without COVID, MicroStrategy doesn't do Bitcoin. And without MicroStrategy doing Bitcoin, probably the next set of companies don't do it. You don't get 24 Bitcoin holders, and then you don't get the accountants interested, and then you don't get fair value accounting, and then you don't get the clamor for the ETFs and the spot ETFs. So that was the next milestone. Then after that, the spot ETF will be the next really big milestone, because it'll be a high bandwidth institutional on-ramp for tens of billions or hundreds of billions of dollars of capital. And so that's really key. So, and then after that, the embrace of the traditional banking networks, right? The Deutsche Banks, the Santanders, other banks starting to custody Bitcoin and provide banking services. So all of those things coming together, they actually deliver digital scarcity as a fungible liquid asset to all classes of investors. Now, if we consider them, the retail investors will benefit. They've been engaged, but there'll be an order of magnitude increase in retail participation with spot ETFs because just about every working person has a 401k that's wired through conventional Wall Street money managers. And so you'll start to see the flow of those kind of funds enabled by the Fidelities and the BlackRocks of the world. And that will increase retail participation by an order of magnitude. I think institutional participation will also increase by orders of magnitude because of the spot ETF. They really can't engage in the current structure because all the institutional money managers have accounting systems, compliance systems, control systems, risk management systems that are all trading systems and collateral systems that have all been built over 30 years. And in that system, they can punch a button and buy $1 million of Apple stock, or $1 million of a gold ETF, or $1 million worth of the S&P index, or $1 million of bonds. And they can just do it instantly, and everything is accounted for. And if they make money, they get compensated. And if they lose money, right, they get criticized. And at the end of the year, their taxes get paid that way. And if they want to buy $100 million, their bank, like JP Morgan, fronts them the money, and so that entire system, which is a combination of technical functionality and accounting functionality and risk management functionality and financing functionality, all of that gets activated by the ETFs. So they will be able to participate, and we will start to see an evolution in portfolio thinking. It's pretty clear that the 60-40 portfolio is a thing of the 20th century, and people are starting to question it.